How long will my $2 million in investments last me? As a CFP who works primarily with people focused on retirement, I get asked this question a lot. But it's not necessarily an easy question to answer. And one of the biggest reasons for this is because it all depends on what type of account the $2 million is held. And just because an account statement says $2 million on it doesn't necessarily mean all $2 million is yours to use. In this video, we're going to look at 4 different scenarios of $2 million being invested and what the actual realizable value is. This may be an eye-opener because we all look at our account balances and assume that the money in there is ours. But in some instances, that just isn't the case. But first, allow me to introduce myself. My name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize taxes as they transition to retirement. I release new videos weekly, so if you enjoy this content, please hit like or subscribe and you'll be notified when the new videos are released. In this video, we're going to go through 4 examples of accounts, starting with the accounts with the truest values to those that offer the lowest. And as we go down the line, you might be surprised about what the true value is. The first example we're going to look at is actually 2 accounts, a cash account and a Roth IRA. Now, both of these offer the truest values because the cash is not in any sort of retirement account. Therefore, all the money in it is yours. Similarly, any distributions from Roth accounts are tax-free. So if we were to liquidate either one of these accounts, the true after-tax value of the account would be the $2 million. Now, an argument could be made that the Roth account potentially offers more benefit than the cash account because any earnings within the Roth are tax-free as well, with some conditions. So you'll want to evaluate these options carefully when considering these accounts for your retirement plan. But as far as realizable value goes, if you were to liquidate the accounts on the same day, they would net the same $2 million. The second account we're going to analyze is the $2 million in a brokerage account. Now, the after-tax value of the brokerage account will be dependent upon the cost basis of the investments in the account. Now, I don't want to go too far down any income tax rabbit holes and bore you to death. Just understand that the cost basis of an investment is effectively what you paid for it. So if you paid close to $2 million for the investment and are planning on selling it for $2 million, there will be almost no taxable gain. And thus, the account value will be truer to its after-tax value. The lower the cost basis, the lower the realizable value. Let's go through a couple of examples. The first is a high cost basis investment. In this example, the account value is the $2 million. The cost basis of the investments is $1.75 million. Again, the cost basis is effectively what you paid for the investments. If you were to sell these investments for $2 million, you would have a gain of $250,000. In our example, we're using capital gains tax rates of 25%, 15% to the feds and 10% to California. So $250,000 times 25% equals $62,500 of taxes. Now, subtracting the $62,500 in taxes from the $2 million in proceeds, we are left with net cash proceeds of $1,937,500. So not too horrible. We took a bit of a haircut on our taxes, but we were still left with the vast majority of the $2 million. But let's go through an example where we have a low cost basis in the investments in the account. In this example, we have the same $2 million of fair market value in the investments. However, we're going to have a low cost basis. A low cost basis essentially means the investment's appreciated since you first purchased them. This could be a situation where you purchased the shares a long time ago and they've appreciated over time, or you purchased a position that has done well in a short period of time. So in this example, let's say our cost basis is $250,000. So if we subtract the $250,000 from the $2 million, we have a gain of $1.75 million. Again, using the same 25% capital gains tax rates leaves us with taxes of $437,500. If we subtract this amount from the sales price, we are left with net cash proceeds of $1,562,500, a significant bit lower than the net cash proceeds from the high cost basis example and the $2 million fair market value. Now, one thing to note here is that I am using the long-term capital gains rates when calculating the tax effect on the brokerage accounts. This assumes that the account holder held the assets for longer than 1 year. If the sold assets were held for less than a year, the tax would be at the ordinary income tax rates, resulting in higher taxes and lower realizable value. We're not going to go through an example, but it's something to be aware of. Which leads us to our final example, the pre-tax retirement account. This account is quite a bit different from our brokerage account. The account balance is still $2 million. However, because the contributions to this account were made on a pre-tax basis, there is no basis in the account. All distributions from the account are 100% taxable. And unlike capital gains treatment we saw in the previous brokerage account examples, distributions from pre-tax IRA accounts are taxed at ordinary income tax rates. In this example, we're using 34% combined tax rate, 24% for the feds and 10% for California. So we take the $2 million times 34%, and that equals taxes of $680,000. When we subtract the taxes paid from the gross proceeds of the distribution, we see that we now have net proceeds of $1.32 million. Quite a significant difference in value from the $2 million we were looking at on our account statement. So here is the summary of the cash proceeds net of tax of our 4 scenarios. As you can see, the after-tax value of these accounts ranges from $2 million to $1.3 million. Would you feel differently about your retirement if you had $700,000 less going into it? I know I would. Now, this scenario doesn't necessarily reflect the reality of what would happen in real life. You probably won't liquidate your accounts all at once to fund your retirement. And you'll probably have more than just one of these type of accounts. Chances are you'll probably have a mix of these different accounts. You may have a pre-tax account and a brokerage account, or a pre-tax, brokerage, and Roth account. And you'll want to make sure that you are strategically drawing from these accounts in such a way that you are using their tax attributes to your advantage. Now, any comprehensive financial plan should include a tax-efficient withdrawal strategy to help mitigate the income taxes you pay as you draw down on your various accounts. If you'd like to know the other questions a comprehensive financial plan will answer, you can watch that video here. If you've made it this far, thanks for watching. If you enjoyed this content, please hit like and subscribe. Thanks again for watching, and I'll see you next time.